Hi folks, I'm creating a series of video in which I will try to take up different type of goals that people try to fulfill and use stock market for that. So you might have seen, right, there are some of your friends who invest exclusively in mutual funds, some are into stocks, some do day trading, so on and so forth. The reason is that each one of them had different goals. That is why this phenomena occurs. So in this series, I'll pick up each goal and talk about what is the most optimal route to take for you to achieve that goal using stock market. This video is about long-term goal. Long-term goal is, I think, the most easily understood. It is about growing wealth in the next 10, 15, 20 years. I'll tell a very short story. There was a movement in Europe that was made very popular. The movement was called FIRE. It stands for Financial Independence, Retire Early. The idea is very simple. The folks used to save a lot of their money from their salaries and put them in either stock market or different instruments based on their risk appetite. The idea was to grow their wealth in the next 15-20 years so that they can retire early. And this concept applies everywhere and for everyone. So if you are in India and you are 25, 35, 45, doesn't matter. You start saving, investing intelligently in the stock market, you will be able to achieve that long-term goal. I am here to help you take that intelligent decision. So what it means to you to achieve that goal. Now, which mutual fund should I pick? Should I pick stock? So if you are an investor who are confused about this, my advice would be to stick to mutual fund. And I would also advise to stick to passively managed mutual fund. Now, why passively managed mutual fund? Index funds are called passively managed mutual fund, and if this acronym looks too complex, don't worry. Give me 2 minutes. I'll explain it to you. Index fund is a form of investing in which the fund manager doesn't use his intelligence to decide which stock to pick. So, for example, if there is a Nifty 50 index fund, the fund manager will put your money in the Nifty 50 stocks in the same weightage which is there in the Nifty 50, which means that if Reliance has a weightage of 5%, then 5% of your money will be put in Reliance. If SDFC has a weightage of 3%, then 3% of your money is put in SDFC. If tomorrow the weightage of Reliance goes up from 5 to 10%, then that proportion will be changed of the money that you have invested. So it's as simple as that, which means that it's passively managed. And it has been proven time and time again that index fund outperform actively managed fund and even experts, which means that as a starting point, you have an edge. If you follow this, you will even beat experts in the long run. So, and the beauty of this is, if you pick up index fund, you don't have to worry that should I change my index fund next year, in the next 5 years. You can just buy once and leave it for 10 years because it's a self-correcting system. It's a very important point. Index funds are self-correcting system, which means that tomorrow if Bharti Airtel, for example, is not performing well, it will be replaced by some other stock, which means it self-corrects. Your money which was in Bharti Airtel will be removed and put in the new stock that is now part of Nifty 50. So it's a self-correcting system. It improves with time. So you can leave it, shut it, forget it kind of investing. I have handpicked 4 mutual funds for you. And again, I don't have to come next year and say this year there are change in the mutual. No, this 4 will, you can put your money and forget about it for 10 years. The rationale of picking 4 is I have picked 2 funds in the large caps category and 2 in mid and small cap category. Just 4 funds. I am never a big fan of diversification. If you are smart enough, if you do your research enough, you will be able to achieve better goals by investing in fewer instruments rather than spreading your money in hundreds of instruments. So the first one is my SBI Nifty 50 index fund. The exact name of the fund is SBI Nifty Index Fund, and this has a very small expense ratio. It tracks the Nifty 50 index, and if Nifty 50 moves up by say 200% in the next 10 years, your money will also grow by exactly 200%. You are rest assured. You don't have to worry that fund manager will change and how will he perform. You don't have to worry about that. If you are a very conservative investor and you have to pick one fund, this is the fund for you. That's it. You are done. Pick one fund and put all your money here. The basic assumption is as the Indian economy grow, Nifty 50 companies are the best place to take advantage of it, and they will grow and your money will grow. As simple as that. The second fund is the Next Nifty fund. And so Nifty 50 and the next Nifty fund comprise the top 100 companies of India. So your best place to capitalize on the growing economy of India. The next Nifty fund, the L&T Nifty Next 50. L&T Nifty Next 50 fund is the best in its category in terms of best. What I mean by best is that they have the lowest expense ratio, because in terms of performance there is no best. Everybody will just track the index. If index goes up by 50%, every index fund in that category will go up by 50%. So I'll pick something which has the lowest expense ratio, that eats less of your money to manage that fund. If you are a conservative investor, if you stick to these two funds, you're good enough. Nifty 50 and Nifty Next 50. One is SBI, managed by SBI, one is by L&T. Now, the next two funds which I'm going to talk about is mid cap fund and a small cap fund. You go to that fund only if you are a slightly aggressive investor. And in a mid cap fund, I like Motilal Oswal, and the exact name is Motilal Oswal Nifty Mid Cap 150 Index Fund. Again, there are only two players in this category, Motilal Oswal and Nippon, and I like Motilal Oswal because of low expense ratio. You should pick mid cap only if you are slightly aggressive investors. Finally, the small cap segment, and I like the Nippon mutual fund there. Nippon India Nifty Small Cap 250 Index Fund. You are practically with these four funds. You are practically invested in top 500 companies of India. Best companies, quality companies, no speculation. These are index which are self-correcting, and how you allocate them is very, very simple. If you are a conservative investor, I would advise you to invest only in Nifty 50 and Nifty Next 50. If you are slightly aggressive, spread it across 4. Rule of thumb is 50% in Nifty 50, 50% in Nifty Next 50 for conservative investors. Slightly aggressive, you could go 40% in Nifty 50, 40% in Nifty Next 50, and 10% in mid cap and 10% in small cap. Extremely aggressive, 30% in Nifty 50, 30% in Nifty Next 50, and 20% in mid cap and small cap. As simple as that. Simple but very effective. It will beat 95% of all managed funds, and it will beat practically all the experts, which means that today if you pick any other mutual fund other than this, you have only 5% chance of beating these 4 funds that I have picked. Hope this was helpful. If you have any comments, please feel free to write in the comment section. You can also watch my video on the power of index investing, or if you can simply do a Google search on YouTube on index investing, Vanguard index funds. Vanguard was the person who actually started this index fund. You will understand the power of this index fund and why I keep suggesting for the retail investor to invest only and only on index fund. Thanks a lot for watching this video. If you have any comments, please feel free to write that in the comment section. Thanks a lot.